Good morning, everyone. Thank you for allowing me the opportunity to present to you today. Brandon, you can go to my first slide, please. Thank you. So today I decided to actually break down and explain some of the mortgage terms that may be stumping clients, friends, family, even yourself. Some you may be familiar with, and some you may think that you understand, but really don't. So do not despair. I'm here to the rescue. Let's break down some terms. First slide. So the first thing to say is that language around mortgage documents and terms is extremely confusing. And that is one of the biggest concerns that I hear from borrowers and clients, even clients that have been in the business of buying and selling homes for a long time. In response to this, I've added time to my regular mortgage process where I break down and explain a few of the key mortgage terms that the borrower may come across in the documents or regular conversations that they have with myself or maybe other people during the mortgage process. The hope is that giving the borrower some firsthand knowledge of these terms and definitions will help empower them with confidence when speaking about their mortgage, and it also help to give you, my fellow BNI family, confidence in speaking with others. Next slide, please. The first term that we're going to consider is property taxes. This is a very common term that everybody pays when they are purchasing a home or owning a home, even if it's a rental, but it still does come up normally for first-time home buyers specifically. Clients do normally forget that they need to take into consideration the property tax amount when looking at the monthly mortgage payment. As it is now becoming more common for the lender to collect and pay the property taxes yearly, this is something that we want to make sure to cover when discussing payment information. The borrower is still responsible for claiming the grant and supplying any requested documents to the lender. These documents may include proof of the claimed grant or the paper copy of the current year's property tax statement. And property taxes are paid, of course, to help fund public needs such as police departments, roads, libraries, and community development projects. Next slide, please. Mortgage insurance is the next term we are going to cover. I'm going to ask this first. Do you feel comfortable to answer if anybody here has mortgage insurance on a home they currently or previously have owned? Personally, I do mortgage insurance on my current home, and this is due to me having less than 20% down payment when we bought. Mortgage insurance can be viewed as a negative, but the truth is that allowing people that have less than down payment saved get into the market, as well as getting lower rates due to the mortgage being protected, which means the lender has less risk. When purchasing a home with less than 20% down, it is usually a requirement that the home be insured. This means that an additional percentage is added to the principal mortgage amount that is then paid to the insurer when the mortgage funds. The percentage ranges, but it is normally capped off at 4% of the principal mortgage amount. The more down payment you have saved that gets you closer to the magic 20% number, the less mortgage insurance you will have to have. Mortgage insurance can also be required by the lender in some specific instances when the borrower does have more than 20% down payment. These can include concerns around the location, borrower, credit issues, or the marketability of the property in case of foreclosure. In Canada, we have 3 mortgage insurance options, including CMHC, Sagen, and Canada Guarantee. CMHC is the most common one on the list that you've probably heard of, and Sagen used to be called Genworth. So if you have that one, it is now called Sagen. Next one, please. What is the difference between principal and interest? This is one we hear a lot. Principal is the actual amount you're taking on as a loan when buying a home. Example of this, you're buying a home for $200,000 and you're using $40,000 as a down payment. The principal portion of the mortgage is now $160,000. The principal balance does shrink over time as you make payments on the home. You can also pay down the principal portion of the mortgage faster by making additional payments or lump sum payments during the mortgage term. You can make lump sum payments up to either 15 or 20% a year of the original mortgage balance without penalty. If you decide to make additional payments on the principal, you are also succeeding in bringing down the amortization of the mortgage faster. Interest is literally the cost of doing business. You're paying interest back to the lender to be allowed access to the mortgage money you have been loaned. A pre-approval versus rate hold. A pre-approval and a rate hold are completely different, but get used interchangeably when speaking about terms. When a client goes into their bank and tells the bank they want to buy a home, the bank will normally look at their income from their job deposits and give them an amount that they would qualify for. This is without considering current debts, employment status, or credit history. This is not a pre-approval, but most banks will call it as such, which helps confuse the clients and can sometimes cause arguments when they come in to see us. These arguments and hurt feelings normally come from the broker completing a full pre-approval and then finding that the amount that the clients qualify for is actually quite a bit lower than the amount the bank stated. A true pre-approval is where a full application has been taken and all documents have been reviewed. These documents can include income documents, proof of employment, 90-day bank statements to show proof of down payment fund, and then completing a credit check. This is where we review any debts or liabilities that the clients have. Once this is done, we then offer a maximum range that they could consider when buying a home. After this point, we submit a rate hold request to a lender, locking in a rate hold for 120 days. If anything changes during this period, then the rate hold and pre-approval can be affected and could be void. Changes can include buying a new vehicle, taking on any new loans or line of credit, or quitting or changing jobs. So if you hate your boss, wait to quit your job until you're done. All documents are then reviewed again once a live deal is now in the process to confirm all details are the same. So now for the last terms we're going to be looking at, we have GDS and TDS. These are called debt servicing ratios. TDS stands for total debt service ratios, and this is where your monthly liabilities, including the new estimated mortgage payment, property taxes, and heat and strata payments, cannot make up more than 44% of your monthly gross income. If your ratio falls above 44%, we have a few select lenders that offer extended ratio programs, but not a lot, only like 2. This is also a good opportunity to consider alternate lending, which we would speak about at this point. Lenders do also have the option of lowering this ratio down to 42% if credit concerns or other issues come up during the application process. GDS is the gross debt service ratio, which is the percentage of your monthly household income that covers your housing costs only. It must not exceed 39% of your monthly gross income, and the ratio can also be lowered due to credit issues. So last slide. Closing costs. This is an awesome term. People never have any idea what a closing cost even is considered or makes up. So they come into the office excited that they've got their down payment that they need saved up for this house that they love, only to get to the part of the conversation where we talk about closing costs and they do not have any additional saved funds. We then have to lower the down payment amount to account for closing costs, and the purchase price that they previously qualified for goes down. So what are closing costs? These are costs and fees that you would pay to the lender or seller at time of closing. Closing costs normally include the rest of the down payment over and above the deposit amount, property transfer tax, which in BC is 1% on the first $200,000, 2% of the $2 million, and 3% on anything over that when it comes to purchase price. We have legal fees, appraisal costs, and inspection costs. Closing costs can also include paying back a portion of the property taxes to the seller if these have already been paid for the year. And normally the lender wants to see the borrower have an additional 1.5% to 2% of the purchase price saved for closing costs, unless you're a first-time home buyer, where we can account for the fact if you're buying under $500,000 that you're not paying your property transfer tax. So we make sure to let the lender know so they don't include those in their debt servicing ratios. So last slide. So now we've since covered some mortgage terms that may be causing some confusion. Are there any questions or other terms you would like me to break down? Thank you very much for the opportunity to present.